For the first time in more than 60 years, both actors and writers are striking in Hollywood. Almost all productions have come to a halt. And that could turn into a big problem for Netflix, which needs to deliver content in order to keep its subscriber growth robust. According to the streaming giant's July earnings report, it added nearly 6 million subscribers in the second quarter, bringing its worldwide total to about 238 million members. This surge comes after Netflix launched its paid sharing program in May, an effort to crack down on account and password sharing. However, revenue from millions of new members wasn't enough to meet Wall Street views. Netflix reported revenue of $8.19 billion in the second quarter, below the street's expectations. These lower profits stem from new subscribers in countries with cheaper service rates, as well as members opting for less expensive ad-supported plans, according to Netflix. Vice President of Equity Research at Wedbush, Alicia Reese, argued although earnings were less than expected for the lower-cost plans last quarter, they're trending upward. She's keeping a close eye on that average revenue per user, or ARPU.
It's getting close to parity, which we think happens maybe in the third quarter, and that fourth quarter at the latest, and that starts to shift towards incremental ARPU fourth quarter and later.
With subscriber numbers hitting record levels, Netflix can expect to see even more returns once college students come back to campuses after summer break.
They're still on their parents' Wi-Fi networks, and they have to be off of a certain the home Wi-Fi network for 3 months before that algorithm trips and Netflix is notified that this person is using the subscription outside of the home network. And then the primary subscriber will then be asked if they want to pay extra for that user or cut them off. And at that point, especially for college students, most of the parents are probably going to keep them on. It's only $8, sure, during that time. So that's all incremental revenue, incremental profitability, incremental free cash flow.
In terms of free cash flow, this is where the SAG and WGA strike may actually help Netflix, because it's not paying production costs. In its July quarterly earnings report, Netflix noted likely $5 billion in free cash flow this year, up significantly from an earlier estimate of $3.5 billion. The streamer said in a letter to investors, "We expect to increase our stock repurchase activity in the second half of 2023, assuming no material change in the business." The WGA walked out in May, with SAG following in July after union members demanded better pay and more money from streaming companies through residual and licensing fees. Netflix co-CEO Ted Sarandos said on the earnings call,
"We've got a lot of work to do. There are a handful of complicated issues. We're super committed to getting to an agreement as soon as possible, one that's equitable and one that enables the industry and everybody in it to move forward into the future."
But Barron's reporter Eric Savitz explained Netflix is a huge target of the strike.
Netflix is kind of viewed as enemy number one. People are picketing outside their offices in LA and in Silicon Valley.
However, the strike is taking less of a toll on Netflix than some of its competitors because of its international productions.
They make programming in Korean and French and Italian, and in some cases those shows have done really, really well, even in the US market. Think about Squid Game, for example, which is filmed in Korean. So the result is they have a deeper base of programming to choose from than some of their streaming rivals.
Even a number of reality television and other unscripted properties have union writers attached to them, so they too are not currently in production. But Netflix already has enough programming ready to go if the strike were to go on for a number of months.
Are the strikes going to be a problem? Yeah. Because at some point in time, people would like to see the next season of, say, Stranger Things, and they can't see it if they don't shoot it.
And then there are live sports, which are actually mostly unaffected by the strikes. But unlike some competitors in network television, Netflix doesn't air any of it. So should the industry's pipeline of new content dry up, the company could run the risk of some viewers theoretically switching the channel to tune into a game. Others who've exhausted their Netflix queues may take the opportunity to catch up on shows they've missed elsewhere. Last year, there were nearly 600 original scripted series offered over broadcast cable and streaming services, according to FX research. With the strikes, this peak TV period could come to an end.
What you're starting to see is budgets are going to tighten. So you've already seen this on some networks where they're going to produce a little less content. They're going to be a little choosier about what they produce.
The streaming company Max recently removed the Westworld series from the platform in order to save money.
Netflix is better positioned than most of their rivals financially, but all of them have pressure to make this a more profitable endeavor.
For Investors Business Daily, I'm Meredith Heyman.